All right, what's up and welcome back everyone to another episode of the Long Game Podcast. And for everybody to the Crossroads, welcome. This is another weekly episode. Today we are joined by Chris Arnold, lead financial planner at SecFi. Chris, thanks for joining us.
Thanks for having me, Thomas. Glad to be here.
Yeah, man. Have you been on a bus before? I actually didn't ask you this before, but I'm interested.
I've tuned into a couple episodes, but this is the first time joining the podcast. So excited to be here and hopefully be able to give some advice to the community.
Yeah, me too, man. So let's talk about, before we get into it, let's just kind of get an introduction to who you are, your story, SecFi a little bit, and then we'll start to talk about equity comp.
For sure. So just recently started up at SecFi about 6 weeks ago. Prior to that, I was at an RIA based out of St. Louis. Started, traditional financial advising, really, got the fundamentals down pat. I, sat for my CFP exam, worked with a lot of, higher net worth investors, primarily retirees, and learned a ton there. I was there for about 5.5 years and, really got, into the weeds in tax planning, some estate and legacy planning strategies. But I found that a lot of people in the retirement in the decumulation phase, once you get a initial plan in place, it's a lot of legwork up front. But once you get that plan in place, it's more of just a monitoring it. And for me, after about 5 years, I felt like I was starting to get a little stagnant. And so have always kind of had an entrepreneurial spirit, and love giving advice to people that are younger in a more relatable life stage. So started out, the journey looking to get in with a fintech company, and SecFi, does financial, they're looking to get into financial planning for startup employees. To date, our business has been around just using some digital tools online to help startup employees, understand like exercise costs. What if their company were to exit for $50 versus $100? Like, what does that mean for their personal situation? And then we do financing. So if you were to leave your company and you needed to exercise and the cost to exercise were more than what you had, SecFi comes in and we can provide a very low risk solution for you to be able to own your shares in the company.
All right. Yeah. And so at All Street, we are definitely work with a lot of people in equity comp, which is, how we kind of got introduced, and the tools that you guys are building is just awesome. I mean, I stumbled upon the website, saw these tools, and I was just like very surprised that they were free. And some of my clients were going to actually start to use them in some of our meetings and just view, what could actually happen if we take this route versus that route. So I'm really happy about that. But for today, let's start to talk about a little bit of, some of the common mistakes you see people make with equity comp. So we won't get like too far into the weeds, but let's just talk about some things that you see a lot of people overlook or skip over.
Yeah, absolutely. I think, there's three common, that stand out, misconceptions. I think the first is, when you join a company and you're awarded stock options as part of your compensation package, people assume that, they own shares in the company and they're a shareholder. And, stock options give you the right to purchase shares in the company, but you still have to actually pay money, out of pocket to be able to become a shareholder. So I always tell people, there's a key term called exercising, and that is, you purchasing the shares. So you don't own shares, from day one. And also, there's usually a vesting cycle. So you typically have to, stay with the company for at least a year. It's a traditional, model. And then after that year, then typically, you're then vested and you can exercise a portion. Common is, 4-year vesting with a 1-year cliff. So after that 1-year anniversary, you're 25% vested. And then the remainder of your options, vest over the subsequent months. So I think that's the big one is, making sure people understand they're not an owner on day one, that there's another step in the process.
I love that one. I actually that probably wouldn't have been one of the ones I picked because I wouldn't have even thought that foundational, but I think that is so important. I think almost everybody I've talked to, they kind of mix up and almost think of them like RSUs, like, hey, you're gifted this and now they're worth something. But with incentive stock options or non-qualified stock options, you have to understand that one, you do have to buy it. It's just an option. You have the right to buy it at this price. And if the price is lower, then you really actually didn't get anything out of it. So when you're at a new company, pre-IPO company, Series A, whatever they're at in funding, it feels pretty good because you expect this company to blow up. But there are some companies that if you get in at a time where the price is pretty high, you might have thought that your ISOs are going to be this huge compensation towards you, but actually become worthless and you don't really get much out of it.
Absolutely. And I think that that's another, key thing to ask, when you were before accepting a job, asking some questions of, what are these, I'm awarded X number of shares, but how many shares are out there? Like what piece of the company do I own? Because you may get offered, 50,000 shares in a company, and that sounds like a lot. But if there's, 100 million shares, in circulation, it is a very small piece. So that's, one question. And then just, really understanding, what is the current value of the company? And some companies will give you the option, from, day one, you can do what's called an early exercise. And that, allows you to be able to buy it. So there's not a difference between, the value at a future date if the company is growing, which then would be considered a taxable event. So those are just some things, to talk to an advisor, to be able to really understand, because there's a lot of, intelligent people that work at startups, but they may have never, been offered, incentive stock options. And so, it's not a knock on them, but it just is to make sure that they fully understand, and, things are transparent so that they, have an idea of what they're getting into, and they can begin making a well-informed, plan and strategy for their life.
Yeah, I totally agree. I love that one. Okay, that's one. What we got for the next one for you?
Yeah. So another common, misconception, and it's floating around on like the Reddit community a lot, but that your options aren't worth anything unless the company, goes public. And I think, that is something to just kind of unpack is, until there is, an exit event, whether your company is acquired by another company or that there is a initial public offering and it's traded on one of the big exchanges, there is a lot, your funds for the most part are locked up. However, there are companies like SecFi, and then some of our competitors, that will offer some financing to be able to give you liquidity. There's also, some secondary, markets or some tender offers that are, ways that investors could be able to buy shares. So I always just like to let people know that, there are other options out there. And if you were an early employee at a very, fast growing company, so say you joined, Airbnb is a common one, back in the early days in 2008, you worked there for 4 years. So now you're fully vested, and then you go on to pursue your next opportunity. Well, unless you exercise your stock, and at 2012, Airbnb was not a publicly traded company. Unless you exercise your stock within 90 days, you forfeit all the value that has, occurred within Airbnb, and you personally are not able to be a beneficiary of that. So even though Airbnb is not trading on, the NASDAQ stock market, there's significant value created, between 2008 and 2012. And you want to be able to exercise that and hold on to it. So when, Airbnb is now a publicly traded company, and it's worth $100 billion, you would have forfeited all that upside. Even though Airbnb was not public at that time, it still was worth something. It just is, it's worth something based on what they call a 409A valuation. That occurs at least once a year or at the time of a fundraising round. But that's something
Yeah.
I just like. There's a lot of, complexities, but I do want people to know that even if you were to leave a company, after, and the company has not gone public yet, those shares are still worth something, and they could
Yeah.
be, worth something down the road. So just don't, assume that because the company hasn't gone public or acquired that, it's meaningless.
So a big thing there, and like not investment advice, but more of kind of a rule of thumb, is like before you leave a company, like if they're vested, you actually have to exercise. If you exercise and leave, even though there might not be a great secondary market to sell, you still own those. So in the future, as that becomes as it appreciates and you want to sell, you have it. But if you never exercise, even though you vested, that means you really got nothing out of it. And I think that's extremely important to understand too, is a lot of these places that you're taking these jobs at that have great equity are because they're paying you less as a startup. So they incentivize you with equity. So if you don't maximize your equity, you basically like took the gravy on top or something that can really help you in the future and just took that less income comparable to probably if you did that same job at a bigger company. So I feel like that's a big mistake that can happen pretty often.
Correct. So yeah, that's something I think, and it, just as a lot of your, listeners are aware, just because you work at a startup, you're not always going to have a successful exit like, the Airbnbs or the Coinbase of the world. Those are exceptional companies. So there is some risk. You want to just make sure that, you're making a well-informed decision. But just knowing that, like you said, you're typically taking, a lower, salary at a, early stage venture than you would be at a more, reputable Fortune 100 company. But that the stock is, the big upside potential. And it can be life-changing wealth. I've seen it do some, incredible things for people in just a very short period of time.
100%. Okay, that's two. What do you got for three?
Yeah, the last one is, a lot of people come to me and say, well, Chris, I didn't sell my stock. I shouldn't owe any taxes on this. And that's the big thing. It comes back to that keyword exercise. And so, we talked about, when you join the company, you are awarded stock options or the right to buy stock at a certain price, a strike price, an exercise price. Those are interchangeable terms. And then as the company continues to grow, again, at least once a year, there's going to be a calculation of value, and that is the 409A value. And so if your company raises another fundraising round, if you acquire, a company and the valuation then, appreciates, or, the company is growing, they're growing revenue. And so investors are, valuing that more, then the difference between the fair market value of the company and then the strike price, that is considered a taxable event from the IRS purposes once you exercise. And so there, you could run into a situation where your company, you can't sell it on a publicly traded market, but you do have a big tax bill owed once you file your taxes. And so we just want to make sure people are aware of that, on the front end before they exercise, so that they have some cash around to be able to pay any necessary taxes, and that they're not surprised once it comes to time to file their taxes.
Yeah. And that's why it's so important to actually know about the equity comp you have, because each one has different rules. So if you have RSUs, when RSUs vest, you basically pay tax on that day. Money is already taken out. You want to think of it as a cash bonus. And that one's a little bit easier to plan for taxes because most of the companies kind of withhold the shares to do that. But then you have non-qualified stock options where it's like you do owe tax on that day based on the difference. And then with incentive stock options, it's you could trigger AMT. So you don't technically owe tax, but if you don't know about this thing through it and you basically exercise too much, where it puts your income in a certain threshold to trigger AMT, you now owe 28% tax when you wouldn't have if you actually planned it. And I think the important part, and something that I see mistaken by a lot of people, is that they only make decisions based on tax. And that's not at all what we're trying to say. What we're trying to say is you have to be aware of the taxes and plan for them, because let's say you do have one of these early stages and you're 10 years in, it's worth a ton of money. You could trigger, $50, $100, $200,000 of tax by AMT, where if you don't plan for it, you're screwed. But we're also not saying that you shouldn't exercise because of that. You just have to be aware of the risk and the trade-offs. And a great example of this is we had a client who they started early on a company, some of their earliest shares were 78 cents. It was worth $92. And their big thing was hey, we don't really want to sell right now because everybody in the company is talking about how good we're going to do, price targets next year. And this brings in a huge thing for me of everybody says their company's going to do well. This is where I feel is a good way to add values. I've never met one person with equity comp that wasn't dude, we are going to take off. We're going to kill it. It's going to be worth triple what it was in 5 years. And you have to realize that is your company's job. Culture, everything. You want to be positive, know about the future, know what we can build upon. Their goal is to keep everybody excited about the company. And so you're going to hear that from the inside. Is that what's going to happen? Maybe, maybe not. And so when you hold and make your decision solely based on the positive outlook you can have, you kind of set yourself up to be in a tough position, because now these people we want to talk about, who we explained why we should diversify part and all the things it could do, they decided to hold on. It went from 92 to 52 over 6 months. You think about that, for them, that went from 2.5 million to 1.25 million worth of value of those shares. And sure, it could bounce back. It could do a lot of things. We don't really know, but you got to, one, think of taxes, but not make decisions on taxes. And two, you have to take a realistic approach. And, I think a good example is sports gambling. I'm a Duke fan. If I'm going to gamble on Duke, I'm going to see every single time how Duke is going to win the game, because you're biased to how you feel about what is going on. It's the same thing with equity comp. We all think it's going to do great. And if you didn't, why would you be working at this company you thought that was terrible and wasn't going to grow? We all have to be aware of those biases that we have and not let taxes or what we're hearing about our own company dictate the decisions that we make, when sometimes we want to make what's the smartest approach for us?
Exactly. And I think that's one of the benefits of being able to work with an advisor, to someone that's, objective, to give you some advice, because You're absolutely right. People that are working at the company, you want them to be bullish. You want them to think that the future is going to be, the company is going to be significantly larger. That's the type of, culture and mentality you want from people that are just energized to work at a company and they're actively working and contributing to the growth. However, with owning any one stock, that is riskier than having a diversified approach. And especially when that stock in the company is who's also paying, your bills and paying your salary, that's additional layer of risk. And so, we want to be able just to be able to say, hey, not every time, the lowest tax cost strategy is going to be the optimal approach for you. There very well could be, a situation where it makes sense to, hang on to some of these options, not exercise them, and wait until there is, an exit event and then do a cashless exercise. And from a tax perspective, you're going to be paying a higher tax rate than if you had exercised earlier, but you're not going to be able to know that, at the time. Like in hindsight, it looks great and say like, oh, I wish I would have just started the clock earlier. But you don't know that. And there could be a global pandemic, there could be an isolated event at your company, there could be a new competitor that emerges. And so there's a lot of risk that could significantly alter the value. And as we've seen lately in public markets, there are a lot of high flying tech stocks last year that have had significant corrections. And for people that did not sell their stock or were not able because either it's privately held or there was an employee lockup period, they're in a real bind because maybe they exercise at a higher price. Now they have a big tax bill due, but the value of the stock is half of that. And so now where they're going to come up with the cash. So those are just all things to keep in mind, before making a big decision, because stock options in a company can do some wonderful things. And really, that's our whole mission is to help unlock financial decisions and clients to help them achieve their goals, starting with their stock options, but just also make them aware that as much as you want to be bullish and believe in your company's future, there are also some events that could affect that. And so let's just make sure that we're taking a responsible approach with managing the stock options.
Yeah, no, I think that's incredibly well said. And I think like kind of the last thing to add too is like from a financial advisor perspective, a lot of times we look at this and you're like, okay, diversify, let's hold on to some wealth. But then there's the whole other side of things of like, diversification is to maintain and preserve wealth. Like obviously 8% return is good, but concentration is how you can truly build wealth. And so like for me, this is why it's helpful, I think, to work with advisors like us who get that. We're young. We understand that there's risks that you can take. Like for me, I will be completely honest. I wouldn't sell out of all of my company stock and move it to a diversified portfolio. I would want to leave part of that to take risk too. Probably not the whole thing. And so I think by talking to an expert, you can start to think through of like, how do we really find that middle ground where we don't feel like we're giving up this upside potential, but also where we're not setting ourselves up where if we are, Peloton, Zoom, or like even worst case, like an Enron or Theranos or something like that, that we aren't just like screwed the rest of our life and we realize that we wasted all of this time and all this money we could have had by holding to hope it's the best. Because at the end of the day, like if you view investment decisions of you have to hit the best spot, you're always going to feel like you're going to fail because you're never going to do that. We're never going to sell at the best point. We're never going to buy at the best point. But what matters is that we just do it at good points and we can still make a ton of progress.
Absolutely. And I think, it all depends upon, what stage of life you're at, what goals you have. And, if this is, say your second or third startup and maybe you had a successful exit, well, then you have the ability to take some additional risks because hopefully you've been able to take some of those, concentrated proceeds off the table. You put it in a more diversified, investment, but maybe this is your first one. And so, similar to how you put money away your 401k, you do that, twice a month or, maybe once a month, depending upon how you're paid. Well, similar, set money aside to be able to cover the exercise cost. And then that way you're slowly, chipping away. Or you mentioned, with incentive stock options, there's a certain threshold that you could be able to exercise without triggering, alternative minimum tax. And maybe, you sit down with the advisor, at the end of the year in December and say, hey, how much could I get, in exercise in my ISOs without triggering, an alternative minimum tax. And so those are just some, situations to just be mindful of the risk you're taking, but also, recognize, this stock, this company that you're working for probably has, the most significant upside potential of any, securities in your portfolio. And so we don't want to, hinder that upside, but we also just want to make sure that, whatever decision you make with how much you exercise and the timing of that, it's not going to cripple you, if the company were to have, a down round or, unfortunately, go out of business, as we've seen, many startups do.
Yeah. And I think that you made a great point. Like you have to understand that if, 20, 50, whatever percent of your portfolio is in one individual stock, you do have to adjust the way the rest of your investments are. So you might want to hold on to extra cash just in case. You might want to scale back and not be in 10 individual stocks, or like, hey, if you're a tech, if like, let's say you're a healthcare tech company, you might not want most of the rest of your portfolio to be in tech, knowing that you already have like 50% here. So you want to view how all of these things go together. And because you don't want to be the person that has 10 individual stocks and then just one thing for your equity comp, and you're sitting here just like 60% swings over a few periods of months. Like that is really hard emotionally, and it like that's going to cause a lot of anxiety too.
Absolutely. I think, one of the blessings of, working a startup is, your company may have, that those swings in valuation, but because there's not a public market that is, reassessing the price every day, a lot of people, that may otherwise sell if their company, were to go down 50%, they're not aware of that. And so or there's not a market to be able to trade. So you have to hang on. But absolutely, I think, to be able to just, to customize a plan where you're comfortable, you can sleep at night, and that regardless of what happens to your company, if there's a, massive IPO and your company, exits for $20 billion, like that is icing on the cake. But if your company doesn't exit, then you are still going to be able to achieve the goals that you have. It may take a little longer, but what we're doing outside of the company stock is putting you in a position to be able to achieve those goals that you have.
It's never good to have your whole future riding on one thing. Like it definitely doesn't make it easier to feel less anxiety about money. That's for sure. But Chris, I mean, I really thank you, man. I thought this was just like absolutely awesome. And I know a lot of people will walk away with a bunch of helpful information. So thanks for joining us. We're going to have you on again sometime in the future. And thanks everybody for listening. Please again, go rate, subscribe, and we'll see you back next week.
For sure. Thanks, Thomas.